Right, in order to start investing, we have to access the Vanguard website. So for UK investors, it's vanguardinvestor.co.uk. Now, if you're in another country, it will have a different website. And if you Google that, you will come up with the website for your country. So as you can see, Vanguard generally is about low-cost investing, and that's why I prefer to use this. And we're just going to go into the fees and charges and have a look. So generally there's a 0.2% charge, and different funds will have different charges, so be lower, it can be higher, depending on what's being offered. And we're just going to go have a look at some of the index funds now. Now here it shows index funds and active funds. So now index funds are funds that just track an index, whereas active funds are managed by managers, which tend to be far higher costs and don't offer such great returns. I'll compare both of them in another video, but I'm just going to refine this now and get rid of the active funds. That gives us 27 funds. Leave that there. And as you can see that each region of the world has its own index fund. So if you're interested in investing in equities or stocks in Europe, then you can invest in these two funds. Then there's also the global fund. So if you want to invest a little bit in each region of the world, so North America, Europe, Asia, etc. Then you've got the UK, so the FTSE Financial Times Stock Exchange 100 Index Trust. If you want something a bit broader than the FTSE 100, that's pretty much all of the publicly listed companies in the UK. Then you've got the Japanese Stock Index Fund, Asia Pacific, and then you've got the US Pacific. That's the US Equity Index Fund. Then we've got emerging markets, and then we've got fixed income, which tend to be bonds. These tend to be, again, very safe. So here you've got the risk rating from 1 to 7. Now 7 being the highest and 1 being the lowest. And as you can see, bonds tend to be generally very safe, so they tend to be on the lower end of the risk, whereas equities or stocks and shares tend to be on the higher end. Right, so we're going to have a look at these ones. So we'll start with the US. You've got the US Equity Index Fund. This is a little bit broader than the S&P 500. So this is the US Equity Index Fund. That's the current price. So that's how much one fund costs. I know this looks a bit higher, but there are some other ones which tend to be a bit cheaper. Number of stocks. So this is the number of stocks this fund consists of. So every time you make an investment, your money is proportionately divided up into each of these stocks. And as you can see, then even if one company doesn't do so well, all other companies tend to do a bit better, and so they make up for it. That's sort of the ongoing cost, again very low, which is good, and that's the risk factor. There's no entry charge, so some funds tend to charge a fee just for the privilege in investing in them, and sometimes they can also charge an exit charge, which is or I should say exit fee, which tends to be paying them if you're selling your investments. And both of these are not present in this fund, which is really good because you get to keep most of your investment. Another thing you might want to look at is the key investor information document. We click on that, and we can see it sort of provides some information. I know it looks like terms and conditions. Don't worry about it too much, but essentially it gives you a brief overview of what the fund wants to do, what the currency is, what the risk profile is, and here are the charges. It also shows you how it's done over the years, so each year how accurately the fund has tracked the index. Now we'll look at price and performance. So looking at price and performance, you can see that how it's performed over the past 18 months or so. As you can see, because of the pandemic, there's been a sharp drop, but it's recovered. And essentially, if you invest in this fund every month regularly, then you tend to buy through this curve. So you buy a few shares when the price is high, and then you tend to buy even more shares when it's low. So overall, it tends to average out. It's called dollar cost averaging or pound cost averaging. It's proven. It's a proven method, and it's the best method to invest in regularly in an index fund. Here you've got the performance. Again, comparing the benchmark against how the fund has actually done. And that's the overall sort of return. It's done over since its inception in May 2009. So if you started in May and invested £10,000, the lump sum, today it would be worth something in the region of 48, call it £50,000 approximately. All right, if we look at portfolio data, we can see that we just want to see where the fund is mainly invested. So it's all North America, specifically in the United States. And in terms of weighted exposure, it's mainly information technology, followed by healthcare, financials, consumer discretionaries, communication services, etc. And your money is invested in different areas. So if one sector doesn't do as well, then sort of the other sectors cushion that. And over time, things tend to grow, so your money grows with it. You've got holding details, so which company your money is actually invested in. So for example, if you were to put, for argument's sake, £100 into this, £4.76 or £4.76 would be invested into Microsoft, £4.20 in Apple, etc. And you sort of get the idea. That way your money is spread over a large number of companies, and hence you're better protected. Let's look at distribution. Distribution is the dividends a company or a fund provides. So this is a return that investors get. Now, as is an accumulation fund, which means any dividends or payments, cash payments that this fund gives gets reinvested. You can also buy income funds. So if you just go in here and look at income funds, that would actually pay it out. So let's have a look at that. Go into income funds, under distribution, and it pays the cash payment annually and it's at the moment it's approximately 1.73%. And again, thinking about savings accounts and ISAs, so savings accounts currently probably give between 0.1% to 1.5%, depending on which bank you're with. And again, this on its own is a lot better. Plus, your money tends to grow over time. Then we've got cost and minimum. So that's the cost of actually investing this fund. And again, it's dirt cheap, just 0.1%. No entry and exit charges. However, you do have to start off with a £500 investment. And if you want to do monthly direct debits, then you can do £100. Now let's look at another one. Now I want to look at, for example, the S&P 500 ETF. Now ETFs are not exactly index funds, but they are very, very similar. And again, they're very low cost. So we just scroll down to the US, which is the S&P 500 ETF. It's much more accessible in terms of price. It's just £45 approximately, and it's got 507 stocks, and the ongoing charge is a little bit cheaper. Similar risk profile. And again, we have a similar sort of story here. The pandemic's caused a huge drop and it's somewhat recovered. And again, it's probably going to be quite volatile in the next few months, probably 1 to 2 years, depending on how this pandemic rolls out. And looking at this since inception, we can see that £10,000 invested here, which is in April 2012, would be worth approximately £25,000 now, which is relatively good. And before this pandemic, this was something £28,000. Not bad at all. We also have portfolio data. So we've got again mainly North American exposure, and here we've got again big on information tech, healthcare, financials, the top 3, and then we've got Microsoft, Apple, Amazon, and other companies. You can have a look through all the other companies by going through all the pages, but I'm just going to go through the top sort of 10. So we've got, tech, followed by some finance and Johnson & Johnson. We've got distribution here. So this one pays a cash payment every quarter. Now these are in dollars, but they would get converted into pounds if you're a UK investor. So you would simply just get a payment in your account here that you open with Vanguard, and then you can move that money into your own bank account. That's the cost. So 0.07%, and again a similar sort of story. Now here you see that the monthly direct debits are £100, but the way to get around this is you can simply just make an investment manually every month, and as the price is about £45 approximately, you can just invest something like that every month. The only issue with that is that you would have to do it yourself rather than it being done automatically. But you can get around that by investing using another platform like Fidelity, but they tend to be a little bit more costly in terms of what they charge in fees. So I just prefer to stick with Vanguard because of that, because I don't mind in just investing something every month myself. We'll just have a look at the one, a UK one as well. So we'll look at the FTSE 100 index fund. So again, that's sort of the price for investing in this, and this is an accumulation. So this one will reinvest any cash payments that the fund pays out. It's got 102 stocks, and it's got 0.06% charge, and again, a very similar risk profile to the others we've looked at. And again, the pricing history, same sort of or similar sort of story here, that the share price collapsed for this fund because of the pandemic, and it's recovered a little bit. And looking at it in terms of its inception, it's done sort of okay-ish. It did quite well just before the pandemic, before coming back down again. Bear in mind though, this only started since 2016, whereas others had started like 2009 and 2012 respectively. So not exact, shouldn't be compared exactly. And my personal opinion, the FTSE 100 doesn't do as well as some of the American counterparts. They tend to deliver much better returns over time. Again, as this is a UK-based index fund, it's pretty much invested in the UK, and it's mainly in financial, consumer goods, and healthcare, the top three sectors where it's invested in. And some of the holdings here, AstraZeneca, HSBC, GlaxoSmithKline, BP, are sort of the large companies that where it's invested in. There will be no distribution in this. But again, if we look at the income share class and go into distribution, again, it pays annually, and the dividend yield is quite juicy. It's 5.55% compared to just 1.73% in the other fund we looked at. And again, that's sort of the history. Bear in mind, this is all in pounds. There's no currency fluctuation that could affect your cash payment. Look at cost and minimum. Again, it's a one-off payment of £500 and monthly direct debits of 100. To invest in something like, for example, the S&P 500, you just hit invest now, continue to purchase, and you can start your application here. Now you can invest in ISAs, which tend to be stock shares ISAs. That's the junior ISA. That's for more like if you have children and you want to start saving or investing for them. That's the general account. There is no tax benefit with this, whereas with the ISA, you do not pay any capital gains tax. That is, if you were to sell your investment for a profit or get any dividends, you don't have to pay any tax on that. And a Vanguard pension pot. I have one of those, and essentially this is putting money away for your retirement. So if you want to start investing for your retirement now, this is a good place to start. Do note that any money you do put into this pot, you will not be able to access it until the age of 55. If you're saving up for a housing deposit or something, or a house deposit, then please do not put your money in here, as you will not be able to access it till then. So let's say you want to open an account, go in there. These are your terms and conditions, generally quite straightforward. Proceed, and then if you go in here, you can just select what you like. So you can put a single payment of £500 in there, and then hit next. Then again, if you just enter your details, pretty straightforward, and hit next, and it's pretty much straightforward from there. I really appreciate you guys watching. I hope you found it useful. If you did, please give it a like, subscribe, and hit the notification bell. If you have any questions, drop them in the comments below and I'll answer them as soon as possible, and I'll see you next time.